All right, what's up, everyone? This is Kirk here again at Option Alpha. Thank you so much for tuning in today, and welcome back to the Option Alpha Show. So today, we've got a very special episode. We're going to be going through some new research on zero DTE time decay. So you might be wondering, why do we do this research? Well, we have been fanatics about zero DTE recently, myself included, trying to figure out how we can do this in our own accounts, how we can trade better with zero DTE, how we can take advantage of it. As you know, zero DTE has been going crazy. The volume of zero DTE contracts has been on a huge rise. In the last year, like just this year to date alone, it accounts for nearly 48% of all SPX volume is zero DTE volume. So it's a huge opportunity to take advantage of. There's lots of liquidity there. So the question always arises for premium sellers like myself and maybe like you, if you're an option seller, is what happens for time decay during these zero DTE contracts. So we did the research on it and we came up with some pretty cool stuff. So first thing we're going to do though, is we're going to jump into the slides. We're going to go through this first screen here because I want to give you a little bit of background on time decay. If you're not familiar with time decay, or if you are familiar with time decay, this is what you would typically see as the theta decay or time decay of a normal contract. So what you have is you have a contract that, let's say, expires in 90 days, and the theta decay would happen somewhat along this type of curve. Now, it might not happen like this every single time. It may not be exactly like this every single time, but what you'll generally find is that theta decay happens like this along the curve for the duration of that contract. So from 90 to 60 days, so basically a 30-day window, that first 30 days of the contract's life, you could say, the premium will decay. You will get some theta decay in there, some time decay for that contract, and it will decay, but not by a lot. So in that first 30 days, say from 90 days to 60 days, you're not getting a lot of decay. Then you go from 60 days into 30 days. Well, now things start to really speed up. And generally and classically, a lot of people think or say, 45 days might be kind of the sweet spot on the theta decay curve where things really kind of accelerate. And maybe that's the case here where you start to see things really kind of accelerate at that point. So from 60 days to 30 days, so the next logical block of days, the next 30-day window, you get a lot more decay than you got in the first 30 days, right? But it's still not totally worthless yet. You're not getting all of the time decay. Your time decay is not accelerating by any meaningful amount. So it's not until you get into the last 30 days of the expiration of that contract. So it's going from 30 days to the last day that the contract is available for trading that you get the actual really acceleration of theta or time decay. And this is, I think, generally what a lot of options traders kind of salivate over is this theta decay where they're putting on positions, they're getting time decay because things aren't moving, against them aggressively. And so the decay of the position is where they make their money. So the question now becomes, well, essentially what happens here? So if you're trading a zero DTE contract, there's no time decay element, essentially, like no classical time decay where you have days and days and days of decay. You don't have 90 and 60 and 30 days of decay. The contract basically expires that same day. So if there is any time decay or if there is any theta decay, how does it manifest itself? How can we track this? What does it look like? So basically what we did is we went through and we did the research and we used minute level data for a huge period of time. I think it was about 30 days worth of data. And that's a lot of data for an SPX position. And essentially what we did is we looked at the theta decay, the premium decay of a position that is an SPX put spread that is 10 points out of the money. So that'd be $10 out of the money, $5 wide SPX out of the money short put spread. So why do we first set this up this way? Number one, SPX is insanely liquid. You can definitely trade it. Not only through Option Alpha and Tradier, but you can trade it pretty much anywhere else. And it's cash settled. It takes advantage of the 60-40 favorable tax treatment. So there's a lot of reasons why you could trade SPX over, say, SPY, which also has zero DTE contracts. But what we did here is we didn't look at just the individual legs. So we've seen other studies out there where people look at individual legs, like selling a strangle or a straddle in SPX, but it's just not realistic. In fact, it's the furthest thing from realistic for most regular traders. Most regular traders, most small traders, you don't have the capital to do $100,000 naked position on SPX. Like, it's just not realistic to do that, right? So most traders, if they're trading SPX and doing zero DTE contracts, they're doing so as $5, maybe $10 wide, $15 wide spreads, depending on if you're doing iron butterflies or regular spreads. But we just looked at a $5 wide spread in SPX, which is $5 on a short put spread, a very realistic position for a trader. So what this means is that this is going to look at the net decay of the position, which again, it's not looking at the individual contracts, but it's looking at the net decay of the position as it goes throughout the trading day. And we did this one a little bit out of the money, so $10 or 10 points out of the money on SPX. And so here was kind of the aggregate of a lot of the data here with this red line. And you can see generally what happens. What I think is fascinating, if you take away kind of the first couple takeaways from this, is that number one is that you don't get linear decay. So I think there are some people who believe that because it's a zero DTE contract, because time is kind of marching along in a very standard progression, you have the first hour of trading and the second hour and the third hour, right? It's not like time is accelerating during the day. But as you get closer to expiration, or as you go through the expiration day, there's maybe an assumption from some traders that a lot of that decay is very linear, and or that you get a lot of decay early in the morning. So I've also seen that too, where some people may assume that you get a lot of decay in the front half of the day, or the front first 30 minutes of the day, the first hour, whatever the case is. But we really didn't see that in this research. So in this research that was looking at these out of the money put spreads, you can see that the decay of these contracts, the net value of this contract, definitely started to accelerate as you got towards the end of the day. There wasn't much decay, if any decay, in the first morning couple hours, really. So from 9:30 to about 11:30, even 12 o'clock, you really didn't get much decay. This could be, synonymous with maybe looking at it on the 90, 60, 30-day time frame that we looked at in the last chart, but only just scrunched down to an entire day's trading session. So around 12 o'clock, you get a little bit of decay, but then you get into, from 12 to about 1 or 2 o'clock, decay starts to accelerate a little bit, obviously, because now we're running out of time. Like, the market is literally running out of time because it closes in a couple hours. And then you get accelerating decay, but it's really not until about 3:30 or so that you get that absolute, really fast, highly aggressive decay that starts to materialize. And this was pretty evident here, where things kind of went from, maybe sort of decay to mega decay, like crazy fast decay around 3:30 in the afternoon. So this is that drop off that you see visually here in the chart, where just the decay of the position just kind of falls off a cliff. I mean, it literally looks like it rode a bike off of a cliff and fell down into the close. So you get that very, very fast decay kind of in the back 30 minutes of the day. I would say that around like 2 o'clock, somewhere in that range or so, you probably get some really accelerating decay for these out of the money positions. So that's very interesting analysis that we saw. So we also did go ahead and stress test this for at the money positions as well. So we kind of wanted to look at everything here. So the previous slide that we were looking at out of the money positions. That would naturally have some decay because they're out of the money, they're not in the money. So there's a little bit of that extrinsic value that's just mostly baked into volatility and time decay. If you look at something that's more at the money contracts, those at the money contracts, and this would literally be buying and selling contracts right at the money, right around, kind of straddling over top of where the SPX price was at the time. Those contracts, because they are at the money and they have a little bit of that intrinsic value kind of baked into them, we saw that those contracts held their value pretty much the entire time. And this is very fascinating, because I think that a lot of people, if you're buying at the money spreads or selling at the money spreads and you're taking more of a directional bet, it's almost like you have to wait till the end of the day to let that bet materialize in this case. So it's maybe not even worth it to make a directional bet where you're doing an at the money position until essentially the end of the day, because you really didn't get, there's no additional premium benefit, decay benefit by selling an at the money put spread. Maybe you're trying to take advantage of a bullish move in the market, right? So you sell an at the money put spread. There's really no benefit to doing that earlier in the day because you didn't get any decay in the contract value. And obviously the market was moving around. It's not like we had 30 days where the market never moved until the close. It's just that premium set, like market participants, market makers, all of us collectively, we really didn't value anything that was at the money until the end of the day, until we realized, hey, this thing is either profitable or not profitable at the end of the day. Now, this was showing that obviously these at the money put spreads and generally the market has been up for most of the days that we were testing it. So you can see that the value of those contracts went down, which means they're profitable if you were selling those at the money spreads. But again, you didn't actually see this materialize until the end of the trading day. And in this case, it was literally the last 5 or 10 minutes for at the money spreads. So key takeaway here is if you're going to be trading at the money positions, maybe you don't even anticipate doing anything until you get to the end of the day. The other thing you could think about here too is that if you are using zero DT contracts for hedging purposes, some of these at the money positions that are used to hedge would be really great hedges because they can hold their value throughout the rest of the day, or generally hold their value. They're not going to decay in value if you're using them to hedge. So that might be a good, interesting way to kind of look at it as well. Okay, so last thing that we looked at as far as this analysis, well, second to last thing that we looked at here was we looked at not only in the out of the money positions, then at the money positions. Then we did the opposite and we said, okay, let's look at selling a short put spread, 10 points in the money. So this is completely different than what we were talking about before, but we weren't looking at out of the money or at the money positions. We were specifically looking at in the money positions to see if the same thing happened just on the opposite side of the option chain. And we saw effectively the same thing. You could say that this chart with the first chart that we looked at essentially are mirror images of one another, where we don't get some premium, not decay, but acceleration, basically as it goes towards full value, towards the spread width of $5. We don't really see that type, materialize until later in the day, about 3:30, it starts to really kind of accelerate and go that direction. So this kind of confirms some of our suspicions that if we're going to be selling premium and we're going to be doing it for zero DT contracts, part of what we might be interested in is that decay, and that decay is going to happen later in the day. Now, of course, there's a lot of gamma risk associated with these zero DTE positions where the premium is moving around really, really fast towards the end of the day, and that gamma risk is accelerated at the end of the day. So that is the trade-off that you're going to take. But if you're trying to hone in and focus in on this time decay aspect, that's what you're going to be looking at is positions later in the day. The last thing that we looked at here was we actually took one particular day, which we thought was interesting, just kind of in this study window, but we looked at what we called Black Monday, but Black Monday was back on August 5th of this year. I don't know if you remember trading around this time period or you remember hearing about it. It almost seems like a blip in time and seems like a distant memory at this point. It's been like a month and a half, 2 months now, right? Since that happened. But essentially there was a lot of talk about the dollar or the dollar yen carry trade unwinding, and markets were down really big at the open. So I think most of the major indexes were down 4 or 5% or more. Then the Fed sent in a bunch of their goons to talk on news in the morning and said, look, we're going to backstop this, rates will go down. Maybe there's an emergency cut, all this stuff, right? And kind of, rebounded the markets. But for a short period of time, we did have what I would consider to be insane volatility. VIX above 50. I think it got maybe as high as 60 or something like that. But it was really, really high volatility. And so we thought, okay, let's take that day out of the bunch and let's just look at that day and figure out, okay, what happened for the same $5 wide SPX out of the money short put spread, 10 points out of the money. Like, how did premium decay for days that were really volatile? And so this is kind of the chart of that. You can see the bid and the ask and the mid price. The mid price is going to be the price you're going to really focus on, which is that green line. Obviously, the early morning hours were just bananas. Volatility was crazy. Markets were jumping all over the place. Everyone was trying to figure out how they were pricing in risk for that particular day. And then you start to see, these spreads, which were really, really wide. So obviously 9:30, 10, 10:30, spreads were insane. Even until, 11, 12 o'clock, spreads were pretty wide on these particular spreads. Like this particular $5 wide spreads, very, very wide. But once you get to the afternoon hours, things kind of calm down a little bit. And then you started to see the little bit of that decay again start to materialize. Now, it's not a lot. You have to kind of almost squint your eyes to kind of see it, but you do see some decay from, say, here at about 12:15 or so. The premium on these out of the money positions was about $2. You get into the afternoon hours, 1:30, or 2:30 or so. It's a little under $2. So there was some decay that started to materialize. It wasn't a lot. It didn't happen really fast. And it wasn't until, again, just the very last couple minutes of the trading day did we start to see, again, that time decay aspect kind of really pop in and time decay really kind of accelerate. I think what's noticeable about this, even though it was just one particular day, is that when you have a high volatility day, you're going to have a lot of volatility in spreads early in the day. That was pretty evident. But B, it's going to behave more like an at the money position for high volatility days. So even though this position was out of the money, this position still behaved as if it was at the money, for all intents and purposes, compared to what we looked at in our research, because we have a lot of volatility. So the position kind of held its value, was a little bit more sticky than it otherwise would have been. And so again, if you're going to be selling premium on high volatility days with 0DT contracts, maybe just kind of forget the morning session, forget most of the afternoon session, focus all of your attention. If your strategy is purely on trying to capture decay and premium decay, then you focus purely your attention on kind of those afternoon hours for trading. Okay, so now that we have kind of that as a background, what I wanted to do is I wanted to jump over and just show you how you can do this inside of your account at Option Alpha. So if you don't already have an account, go ahead and sign up, start a trial here. You can trade 0DT contracts. You can use the Oracle to find new ideas and backtest ideas for 0DT trading. But if you're inside of a bot that you're running, what you can do is you can actually set your bot up. Well, there's a couple different ways you could do it. So I'll show you these different ways here. The first way that you can set this up is you can set this up so your scanner only runs at predefined market times. I have a couple different scanners with some different settings for this bot that I've shared in the community before, which is my 0DT Ninja. But this one here, you can see inside of the scanner settings, if I go into any scanner automation that I'm running where I'm scanning for market opportunities, telling the bot to go through things, I can go over here and I can go to market time and I can set my scanner to run at predefined times. So I can say, all right, this scanner is not even allowed to run until 3 o'clock or later. And so that's a very easy setting because all you have to do is just set up your scanner automation, tell your bot what you want it to scan, and then inside the settings, when you're setting up your scanner here, tell it what days to run and to skip holidays or not, and then tell it what market time to run. That's it. Just say, hey, look, I only want to run this particular scanner at 3 p.m. or later. And so that will run that scanner at 3 p.m. or later. It'll basically start every day at 3 p.m. And that's how you kind of focus and hone in on just that latter part of the day if you want to focus on kind of that latter part of the day. The way that I do it inside of my scanner automation is I actually have different sets of times that I am willing to make trades. So it's a little bit different than just focusing on one time, but the way that I have mine set up is that, so if I'm looking at a position that's selling some premium, say 0.5% out of the money, I will allow the bot to scan from kind of the morning time period until about 12:30. And during that time period, I'm looking for trades that are 45% reward to risk ratio. And so I do it a little bit differently, which is that I still want to maybe look for positions during most of the day. It's just that because I know that time decay and premium decay is not going to be accelerating until the end of the day, I am requiring that my bot find positions that have more aggressive, better risk reward characteristics if it were to find a position. And then at 1:30, I can start backing off those risk reward requirements, still making sure that I'm collecting enough premium to cover the risk, but I can back off those risk reward requirements to 30%. And then maybe at 3:45, you could back it off a little bit more if you want to. I kind of keep it the same. Some of the other ones that I run are a little bit different like this. This one looks at 0.4% out of the money. It stops the first scan period at around 11:30. But inside the market open to about 11:30, it's looking for 70% reward to risk requirement. And then at 12:30, it backs it down to 60%. And then from 2:30 till the end of the day, it backs it down to 45%. So that's why I call this my waterfall, because I'm doing a progressive waterfall at different times during the day. So if you actually look at what the automation is doing inside of it, it's first checking to see if it's approved for trading, which it goes through a process, making sure there's no Fed days or crazy volatility. We just want general market days that we want to trade. And then it checks to see if it's inside the first scan period and if there's an iron condor available that we want to trade that meets our requirements. If there is, it opens the position, manages it, etc. If there's not one available, then we look inside the second scan period and then again inside the third scan period. So you can see how it's kind of going through this waterfall progression through different periods of the day. You don't have to do it like that. You can obviously go in here and you can say market time is after X, time during the day, right? So you can go in here and market time is after, say, 3:30 in the afternoon, and it would only run if it was after 3:30 in the afternoon. But that's a little bit different if you wanted to manage your bots a little bit different. Again, I like to do the kind of waterfall because I'm still willing to make trades during the day. It's just that I want to make sure I'm collecting enough premium to do so. Okay, so I hope this really helped out kind of going through all this. If you guys have any other questions, please let us know. If you thought this research was really helpful, again, please share it on YouTube, give us a thumbs up, give us a comment or a rating, whatever works for you. But we really hope that this is helpful. We're going to be doing more research as we start doing more testing for 0DT contracts. But again, the key here is that if you are trading 0DT, most of that time decay and premium decay happens really, really late in the day. So make sure your trading strategies and your bots and automations are set up appropriately to take care of that time decay later in the day. So hopefully that helps out. If you guys have any questions, let me know. And until next time, happy trading.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.